Hey, what's up guys? It's Clint Coons here, and in this video we're going to talk about your Roth IRA and paying taxes and what you can do to minimize it. Okay, let's get started. Now here's the thing. Many people that have IRAs want to set them up so they can invest in real estate, and that's called a self-directed IRA, and you're probably familiar with the tool, and you may even be using it right now to put your money into real estate or alternative types of investments. But here's the thing. A lot of people who invest in real estate inside of their IRA are not aware that you can actually incur a tax on your IRA. Yeah, that's kind of counterintuitive, right? Because you think, hey, isn't it a IRA a tax-free environment that you can earn money inside of your IRA and you don't pay tax on it until you pull it out? If it's a traditional or if it's a Roth, you never pay tax on it. That is the general rule with one exception. If your IRA is conducting a business, I guess there's two, or it's using debt to make acquisitions, then there's a tax. And it doesn't matter if it's a traditional IRA, self-directed IRA, or a Roth self-directed IRA. So what do I mean by that? Well, think of it this way. You have an IRA right here that you've set up. You got your IRA set up, and you want to buy this house. Now, you could purchase that property with cash for $200,000. But if you did that, you realize if your IRA has $200K in it, that you've just sucked up all of your IRA money and put all that into that one investment. So what savvy real estate investors will do is they will find a lender that will loan them money so they can finance the acquisition of this property inside of their IRA. And so what they're using then is leverage, just like you would if you went out and bought a house in your own name, right? You'd go to the bank, you get a loan, you have to come up with a down payment. Now, when you're using leverage inside of an IRA, you're typically going to have to put down at least 30% because this loan is a non-recourse loan. And what does that mean? Well, you're not liable should you default on the loan to the lender. Unlike your personal residence loan, where if you were to default on the loan and they were to sell your property and there was a deficiency there, they could come after you. In this case, they can only look to the property for recovery. So, assuming that I needed to put down 40% in order to obtain this loan or obtain this property, that means on a $200,000 house, what you're going to be putting down is 40% of the acquisition price. So that would be $80K. So you're going to finance in this situation $120,000. So this is called debt right financing to buy the property. And what's important here with this number is we need to know the percentage. Meaning how much of this property was financed, and then what we have here is we realize 60% of the property was financed. So what does that do for someone? Well, it gives you the ability now, you have $120,000 left over in your IRA, you can go out and buy another house, another $200,000 house with $80K. And so now I'm down to $40,000. So now I'm going to buy a $100,000 house for that $40,000. So I can now buy 3 properties through the use of leverage. Sounds enticing, and a lot of real estate investors do this. But what they fail to realize many times is that when you're using debt in this scenario, all of that adds up and you're going to get taxed on the income now based upon that debt percentage. Okay, what did I just say? What I mean is this. If each of these properties, property number 1 at $200,000 earns $10,000 a year. Property number 2 earns $10,000 a year. Property number 3 earns $8,000 a year. Then we will take 60%, 6K, 6K, oh, 4,800 right here. And so that's 16,800. And that income right there will be subject to taxation inside of your IRA. You actually have to file Form 990T, and you'll pay tax on this at 37%. Ouch, right? I thought the IRA was tax-free. That's why I'm putting my money into it. Well, when you're using debt, you're going to pay tax. Now, I talk to a lot of investors who hear about this and they hit the panic button. Stop the investing. I don't want to do this anymore. I'm going to pay tax. It's not a bad thing if you know how to deal with this issue. So one of the ways in which you can deal with this issue here to minimize your taxes is to silo your assets. Now, what do I mean by that? Rather than just use one self-directed IRA, if you want to invest this way, set up several different self-directed IRAs. Now, by siloing your assets, what you're essentially doing is setting it up so that you have multiple IRAs here. So I have IRA number 1, IRA number 2, and IRA number 3. And I want to position assets amongst those IRAs so that the income that comes from the debt finance portion, let's say that the income here in this IRA, let's assume that it holds 2 properties. And this property has debt financed income of $12K. This one has no debt on that deal. Well, the thing about this, and what I mean by siloing your properties, you're going to group them in ways in which you can depreciate the assets to offset this income. Because yes, when you have an IRA, you're still entitled to depreciate the properties held inside of there. Now, it doesn't benefit you. It's not going to, if I had a loss here on this IRA of $30K, that's not going to flow out to Clint and help me offset my taxes. But I can use that loss to offset the income associated with the asset through that depreciation. So many times when I'm looking at IRAs, I'll look at someone's portfolio and I'll tell them, hey, maybe you want to do some siloing where you're taking assets that have greater depreciation in them and putting them with the assets where there's leverage, so you can use the depreciation here to offset the income over here, so we can wipe out that UDFI, unrelated debt financed income, which sneaks up on IRA investors and causes this type of problem. That's one option. A second option is just scrap all these IRAs, but if it's a Roth, you can't do this. If it's traditional, scrap your IRAs and roll them into a solo 401k, because a solo 401k is not subject to any of this debt stuff that I'm talking about here. It only applies to IRAs. But the problem is, if you're investing through that Roth that I first started talking about, you're pretty much stuck here. You're going to stay in this space. So your option is to look at some siloing of properties, or if I used in my first example where you only have 3 properties and they're all in one IRA, and you're looking for ways to get out of paying tax on your IRA income, consider a cost segregation study. What does that mean? Well, I've got some other videos on cost segregation. It basically means this: you can accelerate the depreciation on your properties. So if you know you're going to be paying down that loan and dropping that income down or that debt down over time, pick up a big tax deduction up front by running a cost seg on this property. So maybe you have $80,000 in deductions. So now you've parked away $80K here. So if you have $12,000 in taxable income, $80,000 in losses, you can see I've got a loss carry forward of $68,000. So I'm using the tax code now to avoid having to pay tax on my Roth IRA profits where I'm using debt financing. Now, the one thing I didn't talk about here is asset protection. Hey, I got another video you should check out that's going to be coming up here in a few weeks, where I discuss a client situation where if you don't use asset protection in your IRA, you may be missing something that could be exposing your assets to a potential lawsuit. But hey, more on that later. Be sure to check back to catch that video in a few weeks. Guys, Clint Coons here. If you liked the video, smash that like button, and don't forget to subscribe to the channel to be notified of other great content as I release it on a weekly basis. Take care.